Imagine getting paid for work you haven't done yet. Sounds amazing, right? It feels like someone handed you a time machine that lets you grab money from the future and spend it today. You see something you want, a phone, a car, a vacation, maybe even furniture for your apartment, and suddenly there's a button that says pay later, or only $35 per month, or 0% interest for the first year. It feels harmless. It feels convenient. It feels like you're being smart with your money. But here's the strange part. Most people don't realize that when they take an easy loan, they are quietly selling pieces of their future income, not in a dramatic way, not all at once, but slowly, month after month. And over time, those small payments start stacking up until your future paycheck is already spoken for before it even arrives. This is the easy loan trap, and once you understand how it works, you'll start seeing it everywhere. Let's start with something most people believe. Loans make life easier, and in many ways, that's true. A loan lets you get something today instead of waiting years to save for it. You want a car? Loan. You want a nicer phone? Monthly payment. You want to renovate your house? Financing. The modern financial system is designed to make borrowing feel normal. In fact, companies work very hard to make borrowing feel painless. Notice how products are rarely advertised with their full price anymore. Instead of saying, this laptop costs $1,200, they say only $45 a month. Suddenly, the purchase feels smaller, more manageable, almost harmless. But something important just happened. Your brain stopped thinking about the total cost and started thinking about the monthly payment. And that small mental shift is exactly where the trap begins. Because once you start thinking in monthly payments, you stop asking the most important question, can I afford this? Instead, you ask, can I afford this per month? And those are two very different questions. Let's imagine someone named Arjun. Arjun just got his first decent job. He earns a good salary, and for the first time in his life, he feels financially independent. Then the offers start appearing. A credit card with a high limit, a phone upgrade with easy installments, a buy now, pay later option for almost everything, a car loan with low monthly payments. None of these feel dangerous. Each payment looks small. Phone, $30 a month. Car, $250 a month. Furniture, $40 a month. Gym membership, $25 a month. Streaming services, $30 a month. Individually, they don't feel like a big deal. But here's the hidden math. Every time Arjun agrees to a payment, he is assigning a portion of his future income. Before long, $400, $600, maybe even $1,000 of his monthly salary is already committed, not to savings, not to investments, not to freedom, but to past decisions, money he already spent. And this is where things quietly become dangerous. Because the more future income you commit, the less flexibility you have in your life. Here's something interesting about human psychology. Our brains are terrible at understanding the future. Psychologists call this present bias. We naturally prioritize what feels good right now while ignoring costs that happen later. Future problems feel distant, abstract, almost imaginary. That's why buying something today feels exciting, while paying for it 6 months later feels like a completely different person's problem. It's almost like we believe our future self will somehow be richer, more disciplined, better at handling money. But when the future finally arrives, we discover something surprising. We are still the same person, with the same paycheck, and now we're carrying yesterday's decisions. This is why easy loans are so powerful. They separate the pleasure of buying from the pain of paying. You enjoy the purchase immediately, but the cost is stretched across dozens of future paychecks. And because each payment feels small, it rarely triggers alarm until one day you realize something strange. Your income increased, but your freedom didn't. Many people believe that higher income automatically leads to financial freedom, but that's not always true. Because income alone doesn't determine freedom, obligations do. Imagine two people who both earn $5,000 per month. Person A has no loans and very few fixed payments. Person B has car payments, phone payments, credit card payments, furniture payments, personal loan payments. Even though they earn the same salary, their financial lives feel completely different. Person A has choices. Person B has commitments. Person A can take risks. Person B has to keep the paycheck coming.
This is what easy loans quietly create, an invisible cage made of monthly payments. And the bars of that cage are not obvious because each payment looks small, but together they control your future. Here's the deeper issue. When you borrow money, you're not just spending today's money, you're spending future income that doesn't exist yet. Think about it like this. Your future salary is like a field that hasn't been harvested. When you take loans, you're selling crops from that field before they grow. You're committing work that you haven't even done yet, which means something important happens. Your future options shrink. Maybe you want to start a business. Maybe you want to switch careers. Maybe you want to travel for a year. Maybe you want to invest aggressively. But if your paycheck is already tied up in obligations, those choices become harder. Not impossible, but harder. And the scary part is, this often happens slowly, one small loan at a time. There's a reason companies push financing options so aggressively, because loans make expensive things feel affordable. A $1,500 phone sounds expensive, but $45 a month, that sounds easy. Car companies understand this perfectly. Instead of asking, can someone afford a $40,000 car, they ask, can someone afford $499 a month? And once customers start thinking this way, they almost always choose the bigger, nicer, more expensive option. Monthly payments make prices feel smaller, which means people buy more and stay in debt longer. From a business perspective, this is brilliant. From a personal finance perspective, it can quietly drain your future wealth. The compounding effect most people miss. Here's another hidden problem. Money that goes towards debt payments is money that cannot compound, and compounding is one of the most powerful forces in building wealth. Imagine investing $400 every month starting at age 25. Over 30 years, that money could grow into a massive investment portfolio. But if that same $400 goes towards loan payments, the opportunity disappears. You're not just paying for a purchase, you're paying the lost opportunity of what that money could become. This is why small monthly payments are more dangerous than they appear, because they don't just affect your present, they quietly reshape your financial future. Now, this doesn't mean all loans are bad. Some loans can actually help you build wealth. For example, education that increases your earning potential. A mortgage for a home you can realistically afford. A business loan that generates income. These types of loans can create opportunities, but the easy loan trap is different. It's borrowing for consumption, things that lose value, things that don't produce income, things that simply make life feel nicer today. Phones, clothes, gadgets, vacations. None of these are inherently bad, but financing them with future income is where the trap appears. So, how do you protect yourself? Here's a simple mental rule that can change how you think about borrowing. Before agreeing to any monthly payment, ask yourself this question. If my income disappeared for 6 months, would this payment still feel safe? If the answer is no, the loan may be stealing too much of your future. Another helpful mental shift is this. Instead of asking, can I afford the monthly payment, ask, is this worth giving up a piece of my future income? Because that's the real cost. Not the interest rate, not the monthly installment, your future freedom. People who build wealth tend to think differently about debt. They are extremely careful about committing future income. They understand that financial freedom comes from flexibility, not just income. They try to keep their fixed payments low. They avoid stacking obligations, and they protect their future cash flow. Because once your income belongs to you, you can invest it, grow it, multiply it. But once it belongs to lenders, your options shrink. The easy loan trap doesn't feel dangerous. There's no warning alarm, no dramatic moment where everything collapses. It happens quietly, one small monthly payment at a time, until your future paychecks are already spoken for. And the strange thing is, most people never notice it happening. So the next time you see the words easy financing, buy now, pay later, only $29 a month, pause for a moment, because what they're really offering is something much bigger than a product. They're offering to trade a piece of your future income for something you want today. And sometimes that trade is worth it, but many times it's a deal your future self will wish you never signed.